Hello, traders. The election results are in, and Donald Trump is our new president. With that in mind, we've gone back into our Election Trading Playbook event and pulled out all of the key insights that our guest offered based on a Trump win. We'll kick things off with a post-election bull market history recap with Mr. Ryan Detrick, Chief Market Strategist at Carson Group.
In bull markets, surprises happen to the upside. Okay, we are in a bull market. We've been in a bull market for a while. We've got an economy that continues to surprise, a consumer that's still pretty healthy, corporate profits at all-time highs. Our valuations stretched a little bit. Yeah, they are stretched a little bit. Doesn't mean they can't continue with profits continue to improve to the upside. So you stack all this on top of each other. And yeah, I mean, we've had surprise the upside, but election years tend to have a late year rally. I don't think this year's going to be different. I wouldn't be shocked at all. We had some pre-election jitters here as we get closer to the election, maybe even after the election a little bit as we kind of side through what it all means. But then we'll get likely that upward bias into the end of the year. And here's just another way of showing this year. Again, this year's up like over 20% or so, at least as of the end of September into early October. And here we are again. This is a really, really good year versus what your average election year looks like. Fourth quarter's best quarter of the year. Again, kind of talked about this already, but just overall, higher close to 80% of the time. It's higher a little bit more when you're in an election year. Sorry. So I'm looking at all fourth quarters up over 80% of the time. Up, what is that? 4.3% average. And just something to think about. Again, it actually is a little bit better in election years like we are. But something also, when you are up 8 of the first 9 months, it's bottom right there. What happens in the fourth quarter? Things get better. Market's been never lower in the fourth quarter, and even better returns. So a good, strong start to a year, like we've seen historically strong start. You actually might get more upside. Now, is that because it's a lot of institutional investors are chasing because they're behind? That's the most logical argument. I think that really could be true. I mean, we do this. I mean, we talk to people all the time. So many people have missed a big chunk of this bull market. And once you get through that election, I think we could again see another chase. We don't see a recession. I'm going to be sounding like a broken record. This is some proprietary data that we have. We have our own leading economic indicators with different inputs. Listen, the LEI, the conference board puts together, has been saying there's a recession for the past 22 months, 23 months, something like that. Ours is not. Okay, ours still does not see a potential recession. We continue to think inflation is last year's problem. We've got a Fed that's now cutting, by the way. When the Fed cuts, there's no recession. What happens? Well, usually stocks have been higher a year later every single time. When the Fed cuts within 2% of an all-time high, like they just did last month, give or take a month ago or so, within 2% all-time high, a year later, S&P's higher. Ready for this? 20 out of 20 times, up almost 14% on average. So you've got inflation coming back. You've got still a pretty solid consumer. You've got corporations growing, hiring slowing down. Yes, but this is that part of the cycle where hiring will slow down a little bit. But again, the majority of the data that we look at, yeah, there's some cracks. You say housing, a little bit of weakness, small business investment. We prefer that to come back a little bit. We think rate cuts really could help those two areas. But all in all, we simply don't see a recession. Kind of what we would say investors should be rooting for. It's kind of this idea of a split Congress. You think about how things are right now. There's 100 seats in the Senate, right? 51 Democrat, 49 Republican. Then you go to the House. Republicans have the smallest House majority in 140 years. All right, so that's gridlock. That's kind of why we think things that have happened in the past, Inflation Reduction Act, it wasn't about inflation reduction. It was about batteries and EVs. Okay, that's okay. Technology stuff, that's good. What else do we have here? The CHIPS Act, right? Bringing things home. We don't like when China goes on lockdown, shutdown, and we want our chips for our phones and our cars and our remote controls and our TVs and all that stuff. So we're bringing that home. CHIPS Act, something both sides of the aisle agreed upon. And when you have gridlock, that can be good. The thing the stock market doesn't like is red waves, blue waves, too much power one way or the other. Then you can spend too much and get too frivolous, and markets don't always like that. So again, that division is kind of not division, but I guess division. Split Congress is what we're looking for. So what's not going to change? Defense spending historically was very low relative to GDP this time a year ago, like the lowest since the early 80s. Look around the world. Look around the globe. Defense spending, whoever wins this election, is probably not going to slow down. It's going to continue to improve or increase is probably the better word to use. Anyway, what does that mean? Well, listen, defense is a big part of industrials. We don't see a recession. We think industrials are a group that whoever wins is probably still going to do pretty well into next year. And again, this defense spending is honestly potentially a tailwind for the economy. We saw it in the 80s, a lot of defense spending. I mean, the government can spend money a lot of different ways, and I get it, defense spending, buying missiles, doing things, but no one's crazy about it. But the reality is again, these are some things that can create potential GDP growth and this overall spending, overall growth down the line. We're the largest oil producer, about 13 million barrels a day. That isn't going to change, right? I mean, we're seeing that under obviously under President Biden. We saw that under President Trump. We don't think it's going to change if Trump or Harris win here, that we are the world's largest producer. Listen, and you hate to say, what are the most dangerous words? This time is different. Sir John Templeton, 4 most dangerous words. This time's different. It is different because the terrible things that happened on October 7th last year, oil spiked initially. What's oil done? I mean, oil spiked here and there, and the war is still going on. The Middle East is still in turmoil, but it's not like crude oil is just soaring way past 104. Crude oil was like $145 back in 2008. All right. There's some deflation there, I guess you could say. And maybe there's different reasons why crude oil, but one of them is, again, the United States is pumping more oil than ever. I think I've got the number here. Yeah, production's doubled since 2011. All right, what anything else here? Production pulled back in 2015-16 amid a weak economy. So yeah, production pulls back a weak economy. We're not sure there's such a weak economy coming, but all in all, we think production is going to remain strong. And with some of the issues out of the Middle East, well, the U.S. can pump a lot of oil now, right? This time is different. 73, 74, oil embargo. We couldn't do that, right? We did not have the luxury to do that back then. So this is something that's probably not going to change. I could spend a lot of time on this. I'm not going to. The US dollar is still the world's reserve currency. As long as anyone listening to this, we have the world's reserve currency. March of 20, what happened? Stocks were killed, bonds were killed. Look it up. Gold did not do well March 20. You know what went up? The US dollar, the cleanest shirt in the dirty laundry. I'm not saying it's great, right? We've got problems, we got issues, but during times of stress and fear, when the you know what hits the fan, people flock to the dollar. The first 10 months of 22, when stocks were doing terribly and bonds were doing the worst they've ever done, the dollar had like its strongest first 10 months to a year ever. So the first time we have a major crisis and the dollar is not a safe asset that people go to catch a bid, then I'll worry. But for now, we don't think it matters who wins this election. We have the world's reserve currency. And when you have the world's reserve currency, can you play by a different set of rules? Listen, I don't like a bunch of debt either. I'm not crazy about it. You're not crazy about it. Every time I speak, people say all about all the debt the country has. But when you have that world's reserve currency, maybe you can, to a degree, play by a different set of rules. And that's just the truth. In 1972, when gold was severed from, dollar was severed from gold, John Connally, a room full of bankers for Treasury Secretary for Nixon, said, you know what? It's our currency, but it's your problem. That, everyone, has been the attitude of debt ever since. I'm not saying it's right. I'm not saying I like it. I'm just saying when you have the world's reserve currency, and every time there's a crisis, we are reminded we do have it. That means you maybe can, to a degree, play by a different set of rules. George Carlin, bipartisan, usually means larger than usual deception is being carried out. They would try to cancel George today, but I think we could really could use him right now. This is just some different stats and figures and stuff we look at. I mean, the US dollar is still being used. You hear things like, oh, people in the Middle East aren't going to take the dollar, to do oil. None of it's true. All right. That's just media stuff. It's not true. They are taking the US dollar. Look around. I mean, I've got the numbers there. Asian Pacific, what is this? 74% of all the transactions use the dollar. The rest of the world, a lot of dollar. Now, maybe not as much in Europe, but you know what? They've got the euro. They'll take your dollar in Europe. You ever been to Europe lately? Oh, they're going to take your dollar. Doesn't mean all those transactions are that way because they're using their own currency. But around the globe, people still take the dollar. The media hype up about Middle East and different countries not taking the dollar, this and that. Maybe Iran might be doing their own thing. But listen, the reality, Iran will take dollars if you give it to them. But the reality is, hey, the dollar's not going anywhere, and we're not seeing any reason to change that. This is just some more context on that. I'm not going to spend a ton of time on this. You can kind of glance at some of these things. But again, foreigners are quite happy to keep, they take our dollar when they buy. I mean, where is it? Foreigners sell a lot of goods to Americans. They get a dollar in exchange. The foreigners don't always buy an equivalent of U.S. goods with U.S. dollar. Instead, they choose to keep that U.S. dollar or U.S. financial assets like treasuries, which, hey, the U.S. is quite happy to supply that. So that isn't changing no matter who wins the election.
Next, Brent Kochuba, founder of Spot Gamma, covers year-end options positioning and the key levels to be mindful of.
We want to talk about positioning and where are traders looking to enter or exit the market. Now, the big thing I want to start with is this skew index, because this helps to frame things rather nicely. What the skew index measures is the prices of out-of-the-money puts relative to at-the-money puts. So essentially, how expensive is tail risk protection? And what you can see here is that it's really relatively high. It's almost at all-time highs in this index, at least going back here to 2000, the mid-2000 teens. And what this is driven by is demand for fairly out-of-the-money puts, as I just mentioned. So, for example, today we saw somebody buying a bunch of 4,700 puts from mid-November, and that is the target zone, that kind of just sub 5,000 area, call it 10% out of the money to 20% out of the money. That's what traders are looking for to hedge. Where does this leave us in terms of positioning? Well, for that, I want to look at what we call gamma by strike, and this is again on the spot gamma platform. And what you're seeing here is two sets of lines. You're seeing orange, which is call gamma, and blue is put gamma, and this is buy strike. So we sum the gamma for every strike using open interest. And the reason we do this, the reason that we weigh things by gamma by strike as opposed to open interest, is because gamma tells us how much hedging flow is associated with various positions. And so you can see here, generally speaking, this is the 5,700 level where we're currently trading. What you're generally seeing is through, call it 5,600 here, it's pretty balanced. What do I mean by that? Call positions and put positions are roughly equal. And when the market is in these regions, when the S&P is in these regions, we have stability of prices. Why is that? Because dealers and market makers, as they hedge, they buy the dip, right? So if the market starts to get weak, they start to buy futures or buy stocks, and that supports the market. Secondarily, if the market starts to rally, they start to sell shares or sell futures into that rally. And the net effect of that is that volatility collapses or contracts, right? We get a very stable market that tends to kind of drift higher. What I want you to notice here is under 5,600, which is right here, put positions pick up versus calls in a major way. So this is all the tail risk hedging we just mentioned in the kind of 4,700 area. But you really see those positions turn to net put positions in this general zone. When you get that situation, what happens is if the S&P breaks 5,600, then you're going to start to see market makers, instead of buying futures and stocks into dips, they start to sell them. And that could really speed up how quickly the market moves to the downside. So that's where we would expect to see, say, the VIX move significantly, 40 plus. That's where you'd see the S&P start dropping, 2% a day. That's where risk really rears its ugly head. So we think it's very important for traders to be watching this level because that is where market maker hedging flows will really start to push that market lower. It's also an interesting place because when you think about elections or just events in general, you can get a lot of short-term volatility as traders are reacting to headlines, right? Okay, one candidate has another lead over another candidate, and the market will jump down to that or jump up versus that. It looks like one country may retaliate against another here. You'll see the markets kind of jerk or respond to that. But the move tends to mean revert, right? The headline gets faded. In this case, we think headlines are generally apt to be faded until we break 5,600. If we break 5,600, then we're going to know that the selling, or we're going to really feel strongly that the selling is real, and then we would be looking for sharply lower markets. The next thing in terms of positioning to look at is back at these skew metrics. So I wanted to pop back because we alluded to this just earlier, that traders were indeed hedging or buying those out of the money options. And you can really see that here in the options pricing. The shaded cone is, again, 90-day average. So this is the 90-day average of 1 month skew. And you can see that there's this separation in here. And what that separation is telling us is that there is arguably excessive demand or extremely elevated demand for these out of the money puts. And so that is really the big takeaway here, is that traders are indeed buying a lot of these out of the money puts. The other place that you can see it is if we go and look at the VIX. And the VIX is interesting, obviously, because that is a great way to hedge of a very volatile event. And in this case, what you can see is that particularly it's this 35 to 40 strike calls, particularly if you start to look more on time, you'll see this. But statistically, these are being driven very high. And this ties into the elevated VVIX that we just mentioned. This is not like nosebleed, unbelievable levels of prices for VIX calls, but they are starting to elevate. And as we mentioned before, we think that these volatility levels, in other words, options prices, are going to start to increase as we get closer to the election and demand for hedges start to pick up. That pretty much covers how traders are positioned here. There is absolutely some tail risk hedging, but traders don't yet appear to be reducing longs, as we can see by the fact that the S&P is again near all-time highs. So the tail risk hedging has come in, and it is not only related to the election, but some of these other events that we have. Okay, so what assets are most likely to be impacted by this election? We really have two key views here, and it's driven by the options positioning. It is that options positioning when it shifts that could really move some of these underlying stocks. The first thing we want to talk about is just the equity market writ large due to the options positioning in this elevated implied volatility. A lot of the banks are targeting, and you'll hear pundits out there targeting the S&P 6,000 level, which is this strike right here, as an end-of-year target. As you can see here in gold, there are tremendous call positions up at that strike, which we think does make it a big target into end of year. And we would also highlight this one right here. This is the 6,055 level. This is where a well-known trade called the JP Morgan collar strike is positioned, and it's positioned for 12/31 expiration. And so if we get the market to rally here, that will be a big magnet for end-of-year positioning. So for that reason, we really like the 6,000 to 6,055 area as an upside target for the S&P 500. Now, why are we leaning on a market rally out of the election? It's because of this idea of implied volatility being very elevated. And if the election is clear, regardless of who wins, if the election is just results that we can all believe in, and it happens in a fairly short time frame, that certainty traders really like, right? Doesn't matter necessarily which candidate I have, just tell me who the candidate is so I can make my investment decisions. If that happens, then what is likely to happen? Well, number one, the VIX and implied volatility is likely to start to drop sharply. And this ties into this idea of Vanna. So I want to show you this model because it helps us to frame this. In this case, we have the S&P 500 price on the x-axis, and on the y-axis here, we have what's called delta notional. So this is roughly how much, in dollar value terms, how much dollars have to be used to hedge out the S&P 500 options positions. So generally speaking, when the market goes down, dealers and market makers have larger notional exposure. Why is that? It's because they're short put options. So the market goes down and you're short puts, you essentially have more long exposure to the market, right? Because the puts are going against you and you need a market rally. So what do you do in that situation? Well, you sell more futures as the market goes down, and that offsets the exposure you have. So let's write this out. So if here we're flat, I'll have to sell, $1 million here, and then $2 million here, and then $3 million here, and so on, right? To maintain my exposure. Well, it works the other way too, right? So let's just say that we're sitting here and the election results come out. What happens? They're clear. There's a clear winner. VIX is going to drop. So the VIX is going to do something like go from 22 down to 15. And what that does is it crushes put values, right? Because those put options, there's so much tail hedging right now that those put prices are very expensive. They require a lot of hedging flow. When that implied vol comes down and like the VIX drops, those put values get crushed. The equity market does not even have to move for that, right? It's just that vol coming down. It crushes those puts. And so all those millions of dollars that we were talking about hedging shorts can all get bought back. And so the result is say roughly, rather than needing $30 billion to hedge yourself on a rally in the market, you're only going to need maybe something like $29 billion. And this is a very short-term metric that we're looking at here, but it frames the idea, right? That the decline in implied volatility means that dealers and market makers need less short hedges so they can buy that back. And that can be extremely powerful. That can drive really sharp rallies in the market. Let's frame this a little bit. If you look back over the last 1 to 2 months or so, what you'll see is a couple of extreme volatility events. Number one, we had the VIX print over 60, right? So VIX 65 in this area. And then we had another volatility kind of spike right around September 11th. And you'll notice how quickly both of these moves mean reverted. We believe this is in a large part due to traders coming out and shorting high volatility levels. What does that mean? They come out and they sell put options or they short the VIX. They do those types of trades, and that helps to rally the market very sharply because it creates buying flow for dealers and market makers. And so in this situation, while we're sitting here, we're waiting for the election results to come out. If the election results are clean, again, that could create this buying impulse that could really push the market higher just on the back of this flow and positional analysis that we have just conducted. And so again, we're really watching that 6,000 level, which is a pretty healthy 5 to 10% rally in the S&P 500.
Next up, we've got Mr. John Bollinger, creator of Bollinger Bands. He's going to be walking us through the Bollinger Band setups of the key indexes that he tracks, as well as offering some insights on the areas of the markets that we should be focused on now that the election is behind us.
But I brought along a sort of the basic TrendSpider workspace that I use to look at stocks and indices and such like that, and a small list of indices, starting with the S&P and running down to a couple of equal weighted indices. And my point here is pretty simple. This market's pretty strong, and it's staying strong. So what we see here is a chart of SPY. Again, I much prefer looking at the tradables rather than the indices. And I have daily and weekly Bollinger Bands on here. This was the feature that first got me interested in TrendSpider, this multi-time frame analysis on one chart. I find it a huge time saver when I'm trying to run through a lot of ideas. So here you see the SPY. It's the S&P 500 ETF making a new high, and really nicely confirmed by %B. That's that middle clip in the screen, middle of the screen there. You can see a series of higher lows in both the daily and weekly versions. And, this is just a very strong market that's well confirmed.
Yeah, what's your perspective on that? Why does the market not care? It's just simply all about interest rates. Do you think that the market will start caring at any point?
I think it probably will start caring, maybe closer to the election. I think the fact that the polls are so tight is part of the reason the market really can't figure out where the advantage is. That's just a guess. Normally, I like to look at the betting results. Interactive Brokers is currently running betting on the elections, and there's numerous other sources. Over the years, those market-oriented views of election results have proved to be very accurate and very useful. But they're virtually a push. Depending on which series you're looking at, one might have a tiny edge over the other. But there's no clear advantage. Meanwhile, I think that there was a lot of worry about the economy, and the market's much more concerned about that. And sort of as a secondary thing in that worry about the economy, they're really focusing on the Fed. But let's just step down and look at a couple of these charts. This is SPY, so this is large cap. This next one is MDY. It's the S&P 400, and it is mid cap, and you can see it is out to a new high as well, and shows exactly the same pattern that we're seeing in the S&P 500. Higher highs and higher lows, both in absolute terms and in relation to the Bollinger Bands, and I really like structures like that. So as you get down in cap size here, we get to a much tougher chart. It's still a good-looking chart, but it has not been able to break to a new high. This is the S&P, the ETF based on the S&P 600 small caps. And we look at a similar situation if we go down to the microcap ETF, but it's even more range bound. So, people are making bets on the big companies that they know and understand. The top 1,000 companies are covered by the S&P, SPY and MDY, but you get down into smaller stuff and people just, there's more uncertainty there. And they're not really marking them up. I also like really to look at these equal weighted ETFs. This is the S&P 500 equal weighted ETF. Everybody's been super concerned about, only 3 stocks are driving this, or only 2 stocks, or 5 stocks. You pick your number, whatever the worry is. But I don't think that it's that big a problem, honestly. Here's a equal weighted S&P 500 ETF, and you can see that all 500 stocks are pulling in one way or another here. They may not all be making new highs together, of course they're not, but there's no divergences here between this and the cap weighted version. When you get those divergences, that's a big worry. And then you zoom out a little bit. This is the Russell 3000, the top 3,000 stocks in the market. It's at new highs and a very similar pattern. And then finally, I really love this. I love this. It's probably my primary market tool. If I just want to find out what's going on in one shot, I come here to the Invesco Russell 1000 equal weighted index. So this is an equal weighted index of the top 1,000 stocks in the market. NVIDIA is not driving this, right? The average stock is driving this, and you can see it's a very constructive pattern.
One thing that I notice across all of these charts, at least on the daily, the bands are tighter than they've been in months. You got to look back to like June or July to see the bands as tight as they are right now. What is your read on kind of that setup?
So we call that a squeeze, or we're approaching a squeeze. Going back to SPY, you can see a really low level here. But if you look at the weeklies, it's nowhere near as low on an absolute basis, but it is as low on a relative basis. So generally these periods of compression like this lead to some form of release, and most people like to think that it's a forecast for prices to move lower, but in this case it's forecast for prices to move higher. And you can see it as you flip through these guys. It's the same for all of them. There's a lot of compression, and we're just breaking out of the upper band for all but the 2 smallest of even the equal weighted ones are breaking out of the upper band. So the big question, of course, on everybody's mind, we're investment managers. We're classic RIAs, and when the small caps and the mid cap and the mid caps go, they really go. So that I think the big question is for everybody is when participation is going to broaden out.
What visual cues should traders be looking for on those charts using Bollinger Bands to identify that they are kind of making that move that you're looking for, and that move is like sticking?
So let's go back to SPY. So we call this a walk up the upper band, and it's pretty well confirmed. You can see it's walking up both the daily and the weekly upper band. So until you see some separation from that, we would, in technical terms, we call that a type of divergence. Until you see some separation, prices can and do walk up the upper band for extended periods, and there's no sign of separation yet. So if you look down a little bit further, the equal weight here is doing exactly the same thing, and the Russell 3000 here is doing exactly the same thing. So the support is very broad here.
How exactly do you define separation?
Oh, literally just price separating from the upper band. You can see that we're actually out above the upper band. When you can you see my pointer here?
Yep.
Oh, okay. So right now, %B, which tells us where we are in relation to the Bollinger Bands, is well above above 1, which tells us that we're trading above the upper band. And you can see that, back here, we tried to break out and failed, just pulled back to the middle band. That's a very normal bit of activity, right? You get a little bit ahead of yourself, and prices consolidate and pull back toward the middle band, such like that, and then start back up again. That's very bullish activity. So separation would look like you run up here a little bit, and the band expands even higher, and you find percent B down here messing around with 0.5 or 0.6 or something like that. That would be the first alert, and then you would want to start paying a lot more attention.
What about particular names going into the election or maybe post-election? Is there anything aside from those key indexes that you kind of went over at the beginning? Are there any names that are sticking out to you as, just names that you're particularly interested in?
Well, we in a little pre-interview before we did this, we talked about NVIDIA, and everybody was betting that NVIDIA was done, but it doesn't quite look like it's done, right?
It sure doesn't.
I like the leadership here. I think you should stick with what's working, and I really mean that. So when it's time for smaller stocks, I'm all over them. But I don't think you should be buying things that are just basing, or I think in this type of market where uncertainty is as high as it is, you really need to own the leadership.
Next up, we're joined by Mr. Tyler Wood and Alex Cole, founders of GoNoGo Charts. They're going to be walking us through the setups on all of the major sector ETFs.
If we dive under the hood of an index, we can take a look at sectors, we can take a look at industry groups. And so for the S&P 500, let's run through the sector ETFs real quick and just get a sense of the overall trend of what's happening. And then we'll look at a couple of ratio charts as well. So let's start from the top. XLK is the information technology sector. I'm seeing go trends, Alex. Talk to me.
Yeah, absolutely. I mean, that's a pretty nice one. Of course, there was a pretty big fallback here from the go trend counter trend correction icon, but stayed in go bars. We can see that the oscillator right now is testing the zero line. We're in a go no go squeeze, so we're going to watch to see in which direction that resolves. But yep, a go trend for the XLK.
How about XLY, consumer discretionary?
Yeah, very similar story. We did see some amber bars creep in at these periods where prices fell back, but no goes. And now we're in go colors with the oscillator in positive territory as well.
Fantastic. How about the communications sector, XLC?
Even better. The sort of pullbacks even less pronounced for the communications sector. And we can see that the oscillator's been finding support at zero over the last several months. So new highs, positive momentum, go trend for all of these growth sectors on a weekly basis.
Now, I know I'm cheating because I've already looked at the industry groups that make up the communications sector. Those that are pulling this higher include media companies and advertising. And who would have thought that in a highly contested, very dramatic national election for the presidency of the United States of America that there might be more ad spending, more advertising? Yeah. So if there's one takeaway for elections, it doesn't matter which candidate you are rooting for, you can participate in communications trends as all of that ad spending ramps up. All right, let's move along and take a look at the XLE, the energy sector.
Yeah, so as we saw with the oil charts, the energy sector has been super choppy, especially on this weekly basis. So not really telling us much here other than market is unsure. We're seeing these amber go fish bars, oscillators struggling to get away from the zero level. So a very choppy chart for XLE.
Absolutely. And let's move on. How about industrials? XLI.
Yeah, so the industrials has been in a solid trend. We did see that period here where we dropped below the zero line and then a no-go for a few weeks or a month. But then for the last sort of almost a year now, or just about a year, we're seeing that trend take place. Go colors, oscillator in positive territory. So looking pretty good for industrials as well.
Absolutely. How about materials? XLB.
Yeah, similar story, a little bit more movement, but yeah, we're in a go trend, strong blue bars, oscillator positive territory. And we're seeing all of these continuation icons as price moves sideways. You can see how many times the oscillator went back into positive territory. So that was a good sign. And then, of course, now we've made new highs.
And I love that there isn't a clutter of indicators on that price panel, because we were in a range bound area and broke to the upside, and now that trend is moving higher. Being able to identify Darvis boxes or flags or pennants, whatever pattern recognition you may have read about in your studies, being able to see a clear price panel is powerful to see those clear levels of breakout. Moving on, let's take a look at the financials sector, XLF.
Yeah, again, on a weekly chart, what a nice move. Very sort of smooth and consistent, not a lot of pullbacks. And you can see again how important that zero line is when we're in a strong trend. You see that period of sideways movement and then the breakout higher as the oscillator breaks out of a max go-no-go squeeze here. It's already found support again, and now we're at higher prices. So you can see very consistent momentum here, staying at a value of 3. So we're watching that now, but definitely momentum on the side of the go trend.
And how about healthcare, XLV?
Almost the same, right? Like strong trend, oscillator finding support. Now instead of being in positive territory, we're seeing the oscillator back at 0. So we're watching that test of the 0 line. If it finds support here, we'll look at likely trend continuation on the price panel.
Absolutely. And let's take a look at consumer staples, XLP.
Another one. I mean, this is the beauty of pulling things back, right? And like making sure you're looking at the larger context, because we are seeing strong moves across these sectors for participation in the larger trend of the S&P.
Mm-hmm. And utilities, which had been rip-roaring this year as electricity prices continuing to climb. Yeah. Another bull market chart there, Alex.
Yeah, and this is just real quick to highlight the length of this no-go move and then how important the breakout of these squeezes was here. Like a long, drawn-out max go-no-go squeeze as price shrunk. Same thing here. And each time we're seeing, okay, a little bit more positive inclination here. And then when it breaks, that's the leading indicator for the go trend. So remember, momentum is a leading indicator. We've all done that sort of traditional technical study, and we know that momentum is a leading indicator. So as that momentum changes from being primarily below the 0 line to being primarily above the 0 line, that leads us then into the go trend. And now we're finding support and we're in positive territory.
And last but not least, XLRE, the real estate market.
Yeah. Is it a sector? Isn't it a sector? But the chart's fairly similar. We're in a go trend at just coming off highs. Going to watch to see what happens here when the oscillator approaches the 0 line. We'll look to see if it finds support, in which case go trend likely to continue.
Now, I know we are coming up on time, but one of the most powerful concepts in technical analysis is relative strength. So we just went through all 11 sector spider ETFs to take a look under the hood of the S&P 500. What we would do at GoNoGo Charts is to look at the ratios of those sectors against the benchmark. The concept of relative strength is we want to own those things that are beating our benchmark, looking for longs and shorts based on the relative momentum of those sectors. So just as a quick example, let's take a look at the XLC versus the SPY. And in TrendSpider, it's just a simple division of the sector over the benchmark. And we can see that it's been tracking quite tightly and yet outperforming if we go back to the start of this bull market in 2023. Yep. So for all of you at home, I encourage you to take a look at ratio charts whenever you're looking at your top-down perspective. You can do this across the asset classes. You can do this sectors to a benchmark index. You can do this individual securities against either their sector, their industry group, or the broader market. That's a really powerful concept in technical analysis, and one that we use every single day. Alex, the last thing I think we wanted to touch on were just some of the thematic moves that might lead us into year end, and probably not going to be changing their trend conditions based on the presidential election. Let's hit these real quick. Pull up the ticker symbol IAI. And so when we looked at the financials sector of the markets, we know that that's a broad mix of banks and large global banks and municipal banks. This is an ETF of broker dealers and exchanges. So if you really enjoy trading and don't love paying exchange fees, this is the chart for you because you can profit on their profitability. Broker dealers and exchanges have been in a very strong go trend. Look at the positive momentum and one test of the zero line giving us a trend continuation. How about cloud computing, Alex? SKYY. Wow, say that 5 times fast. You're going to be in a pop song. There's a bull market, and we're not seeing that change at all. So a lot of media attention on the AI revolution, a lot of focus on the semiconductor space, but there's a lot more happening, innovative work across the marketplace. Some of these thematic ETFs really caught our attention when we were doing scanning and screening. How about one more? Cybersecurity, ticker symbol HACK, HACK. Not a bad trend, right?
Yeah, and what's interesting here is that we seem to be taking out these prior highs, right? So we failed here, but now we seem to be consolidating above those levels, and the oscillator's in positive territory, and we're seeing strong go bars. So that's a nice sign as well.
Absolutely.
Now let's get into the picks, and we'll start with Mr. Matt Caruso, founder of Caruso Insights, and he's going to be sharing with us the key names that he's identified under a Trump presidency.
But if we take a look at this one moment, and if we take a look here at Argentina, they had a new government elected with Milei, and he is a very kind of pro-capitalist, deregulation focused leader. And what's interesting is from when he was elected in the fall of 2022, we can then compare this with what's gone on versus the US. The Argentina ETF is up 112% to the end of September, whereas the S&P 500 is only up 40% over that same period of time. So it's really interesting to see kind of the more socialist policies of Canada led to a less than optimal outcome in terms of economic performance and as well stock market performance. It's a little early to look at just the economics of it with Argentina, but you can just looking at stock market performance, it's a pretty dramatic difference. Now, obviously, it's a smaller economy, so there's different impacts, and obviously, it came from a very bad situation in terms of inflation. But it's just interesting to see how taking a dramatic shift on economic views, going after deregulation, and allowing individual actors to kind of lead their future rather than have more of a top-down view, has led to a very powerful stock market. So, in my view, depending on who gets elected. And even at a federal level, there's only so much power someone has. But in general, I think a President Trump presidency would probably result in stronger general economic growth, stronger stock markets, and more economic prosperity. First off, let's talk about GEV, because I really have this under both presidents, because I just think it's a great company, and their diversified operations really allow them to do well in all situations. So GE Vernova is a recent spin-off from General Electric. They split the company into 3 different portions. GE Vernova is the portion that works on energy. So they have 3 different divisions. They have oil and gas, they have wind energy, which is renewables, and they have small modular reactors, which is nuclear. So they really have kind of the their position in really all of the important markets. So with this very large build-out that's taking place for AI, and just in general, electrification, even under Harris, there's a constant push more for electric vehicles. So there's going to be more and more demand on the system for electricity. I think AI has just kind of really fast forwarded that progress. So if we take a look at GE Vernova, they recently IPO'd. They had their first rally off of that IPO, and they went through a very healthy basing structure. From here, we've had a substantial advance. And this may look like it's extended, but from the big scheme, the big perspective of the amount of growth coming to this sector, I still think it's early days. And I think they're perfectly positioned to be able to support the growth for AI infrastructure. So yes, this is extended from, this is its 10-week moving average, the same as its 50-day moving average. But it's really interesting to take a look at what GEV is doing at the same time. If you kind of compare that to what the S&P 500 has done, which has also been strong, it's it has been substantially stronger than the S&P 500 over the same period of time. So I think GEV is definitely a leader in the market and a leader within a key theme. Looking at how to position through this, so we do have earnings coming up in just about a couple of weeks. But as a very, very strong leader, barring some kind of extreme disappointment on earnings, this is a stock that I'm constantly looking to add to my position. I was lucky and fortunate enough to build positions in this area here as it was coming out of this basing structure. And this is one where it is extended the short term, but this is one where I'll be looking to buy on any kind of weakness. It is a utility, so it's unlikely for this to stay so extended for a prolonged period of time. But rather, as a utility, this is something that usually, as it pulls back, becomes a very nice buying opportunity into a key theme. So again, whether it's Trump, which again, deregulation will probably push AI infrastructure to be grown even faster. But under Harris, equally, there's very strong demand for electricity, whether it's going to be AI or also electric vehicle incentives. I think GEV is extremely well positioned to benefit from both of those. However, in addition to GEV, one that I think would do even better under a Trump presidency would be Cameco. So if we bring up Cameco, we spoke about the nuclear energy and the reopening of the plant in Pennsylvania. The uranium market is one where there's a couple of main players. There's Kazakhstan, which has they're basically the Saudi Arabia of uranium, and number two is Canada, also has dramatic deposits. For many years after the kind of the Fukushima disaster, if we take a long-term picture of Cameco, we go back in time, that was in 2011. You can still see the gap down from when there was that meltdown in Japan, and basically nuclear energy became an unwanted energy source for many, many years. So it's interesting to see how this went from an energy source that completely was not wanted to suddenly reopening nuclear plants, which is a very big decision because these are plants that you need to have substantial supplies, substantial uranium on site, so you can always keep energy moving at a constant pace. So the main business in the uranium business is long-term contracting. They don't usually work off of spot like the oil market. Their focus really is on long-term contracts for sustained supply to all of the different reactors. So there aren't many players in the market to begin with. There's the Kazatomprom, which is from Kazakhstan, and there's Cameco, which is Canadian. Now, obviously, if there is a push for more domestic or at least friendly supplies, I think that positions Cameco as a unique opportunity in a space that's building out. I think what's interesting is, again, there's not a lot of open supply because for so many years, this was a no-go industry because nuclear was pretty much dead. So suddenly from going from no interest to suddenly a lot of interest is going to put a lot of upward pressure, I think, on uranium prices if this trend persists. I mean, Google's already spoken about looking to reopen nuclear reactors as well. So it looks like a developing trend. And I think under Trump, if his focus is about domestic or friendly supplies, I think that plays well to Cameco as a major. And if you take a look also at their earnings, you can see their earnings line here, how earnings have dramatically changed from a relatively poor situation just a couple of years ago to where now Cameco is printing some fairly nice earnings per share. So some pretty steady growth year over year for the different quarters, which is impressive overall as a trend. A very small cap or focused domestic opportunity, I think, would be UEC, Uranium Energy. This obviously is a small cap stock, so it's not really, doesn't have the same kind of stability as a Cameco, but their operations are almost entirely US based. And they spent many years putting together their production profile. So I think if there is a dramatic move in the uranium price and there's a continued push into nuclear, I think specifically under Trump, these companies stand to benefit quite a bit. The next theme I'd like to take a look at is Tesla. So we spoke briefly about autonomous driving, and in reality, I don't think either administration would hamper the developments in the industry, and if either Musk or a competitor would develop autonomous vehicles, I think in general this would be a net positive for society. But obviously, with Elon Musk being a substantial supporter of Donald Trump this election and having a super PAC, speaking at his rallies, I think clearly it'll just be that much better for Tesla if they have a competing product versus another competitor. But really, I see this as a broad trend. But obviously, Musk having such a close relationship now with the president will obviously, I think, be, if anything, in a slightly better position than some different competitors should Trump be elected. Taking a look at Tesla, we've been in a prolonged sideways consolidation pattern. This had a dramatic move up into 2021. It's interesting. This is still trading at a very high multiple relative to other car makers. I mean, if you're taking a look at Ford and others, I mean, these are very low PE stocks, whereas Tesla is trading at a much, much higher multiple. And in reality, I think there's been a lot of time taking place here where people see all of the ancillary businesses in addition to electric vehicles that Musk has been working on. For it to command its multiple, I think he has to be able to bring those finally to market and show them, or eventually the market will be disappointed. But you can see here from a technical perspective how really the opinion on Tesla is getting closer to a unanimous opinion. The volatility is condensing. We're going to find out very soon, are the bulls correct and we break out to the upside, or will the bears be correct and we'll break down to the downside? We have the robo-taxi from, as we're speaking now, the robo-taxi event will be taking place tomorrow night. So it'll be interesting to see what Musk does and if it can break out of this pattern. It could be short-term if good news is announced, or even maybe down the road if it's something that will take some time, but greater visibility is going to be very important here for Tesla. Another kind of company that has been vocal, in terms of Trump support has been Palantir Technologies. And again, this is interesting because they're just now attempting to break out of what was the highs of their IPO. But this is being regarded, in my opinion, finally being understood as probably the first pure play software solution for AI at an enterprise level. I mean, everyone has, I think ChatGPT is what got everyone excited with AI. It's what helped lift the NVIDIA stock. I think people are now recognizing that, for a lot of, especially enterprises, large companies who want to bring on a lot of this capability, it's still not so simple that you can just plug a chatbot into it. So the capabilities are immense, but you need the right software infrastructure to be able to onboard enterprise clients. I think that's where Palantir fits in this equation. But what's particularly interesting about Palantir is they also have a very strong defense business as well. Trump is a very pro-defense president. He's all about always mentioning how he wants to rebuild the military and all the rest. I think going forward, a lot of the military budget more and more is going to go towards software, whereas in the past, a lot of the the physical manifestations of war, such as planes, etc., General Dynamics, Lockheed Martin, all the rest, have been where they've gotten most of the dollars in terms of defense budget. I think Palantir is going to play a bigger and bigger role, and again, given kind of the general support for even Palantir employees and all the rest for Trump, I think this stands to benefit both from a Trump presidency and just the incredibly strong tailwinds into AI, general AI adoption, and as well as AI adoption in defense. So Palantir is one that I'm watching very closely from that perspective. Again, this has had a strong move, but big picture, this is just breaking out of its very large IPO basing structure. So again, they are taking on massive markets. We spoke about the defense market. They have taken on very big contracts in the health market. They've worked very closely with the UK's national health system to bring down the cost of operation for hospitals, to speed up and optimize health delivery. So again, tackling very big businesses, very big total addressable markets. I think they have a huge runway in front of them. It's interesting, if you hear the CEO speak, his viewpoint is really kind of, which countries do they allow to use their software in terms of defense? Whenever you have a product where you get to kind of decide who is allowed to use your product, I mean, that's a very powerful position to be in. And that's one usually only in a leadership position.
Next, Mr. Shay Boloor, host of the Wolf podcast, is going to be walking us through the technical and fundamental setups of his top Trump picks.
What happens if Donald Trump wins the presidency? The first thing I want to bring up is the new AI darling, Palantir. So as you can see over here, Palantir, this is the top 15 most expensive growth stocks in the market right now. And if you look at the EV to gross profit, it has nearly 40 to 50% higher EV to gross profit multiple than the next level, which is Samsara at 27.9. So it is very expensive among the group. However, it's justified because there has been a narrative in the software space where AI will be cannibalizing the whole industry, which I think is absolutely accurate. However, there's going to be a handful of names that are going to come out of this stronger and they're going to be able to charge unprecedented power if they can solidify themselves in the enterprise AI tech stack. Palantir has proven in the last 2 earnings they belong in that tech stack, and because of that, the market's bidding them up. Hence the 153 year-to-date profit, 153 year-to-date performance in 2024. But under Trump, that's why they're like the clear AI play, because there's a security component to them as well, where in the Trump administration, Palantir could utilize their AI first mover advantage in data integration and analytics to secure a lot more larger and more complex government contracts for national security, immigration control, defense. If they are known as like how NVIDIA is known as the AI hardware play, Palantir is being known as an AI software play. I think that Trump's going to want to protect USA as much as possible against any kind of foreign threat. He's going to allocate a lot of budget towards that. And I think Palantir will be a direct beneficiary off that, because they have a large component of their revenue is from the government. I think that's going to pick it up if Trump is the president. So let's see how their chart looks. Palantir's chart is breaking out. Is the previous high right here was back in 2021. They are breaking out over here after the last earnings report. It is just taking off every single day. It's an all-time high. So I think this continues to run with the large government contracts being factored into their next couple earnings, or next couple years of earnings due to the government side, while also corresponding with the commercial success they're seeing in enterprise AI. That's 2 massive tailwinds for this name. So that's why it's my number 1 stock on the Trump-led presidency, because we're seeing the strength in the commercial enterprise AI space for Palantir. The government side is very unpredictable. You can't predict what the deals are going to come through. They're consistently renewing, but the timing of it's tricky. But if Trump's goal is for increased security, national security, he's going to use AI, and you can anticipate the deals are going to be a lot more constant, a lot higher. So if there's any kind of pullback ahead of the election, I do like the $36 level. The next level is around $33. But like this name, like ever since May 2023, this massive bottom candle, that's accumulation. A lot of new investors got into the stock then. Like it's shown consistent support along the way, testing it multiple times in summer of 2023, and then again in January 2024. I don't think we ever hit this level, but I do think that's something good to call out just in case. $22. But the next volume shelf is $25. I don't think we're going to get there. I really think there's just so many tailwinds for a name like Palantir that you're going to have to take the quicker wins, which is $36 and then $32. So that's my first name. It's national security, but within the AI thematic for a Trump-led presidency. The next one is going to be Coinbase. I think crypto is going to be absolutely bullish if Trump wins the election. And mainly because he's more lenient on regulation, and especially in early secular growth themes like crypto. And I think his pro-crypto regulatory environment that he had in the prior presidency, I think that's going to be maybe the tailwind needed, or a catalyst needed to kind of push a lot of the cryptocurrency as a mainstream financial asset potentially in the future, next couple of years, and maybe help like with the SEC regulations and compliance standards. Either way, Coinbase is going to be one of the biggest beneficiaries off this, mainly because the reason I cite Coin, like again, I use these three brokerages as my comps for what crypto move to do at, rather than like, I don't want to do the crypto mining companies. Like I want a brokerage that has crypto exposure. That's like my main play, even though I think Bitcoin's a great investment as well. Same with Ethereum, but like using US equities, I do think Coinbase is the best name among all three of these, because a good example is like Coinbase's volume is around $37 billion in like crypto volume, trading volume, nearly double what Robinhood's is. However, Robinhood makes only 81 million off of their crypto trading volume, while Coinbase makes nearly 8x that. So the good example is Coinbase makes 8 times more revenue than Robinhood on crypto trading volume. So clearly the juice is being made for Coinbase. And I think it's because of a lot of institutional trades are happening on Coinbase versus Robinhood, which is very retail centric. So where do I buy? Now I know what to buy. When do I buy in Coinbase? So let's look at the chart over here. Coinbase is interesting because it isn't near at all-time highs, even though crypto is kind of picking back a bit this week. It's struggling to catch a bid. So the first metric I want to use is like, all right, anchored VWAP. Where is the new? There's been a lot of new investors in Coinbase after it bottomed in 2022 and it's been basing for the next couple of years. A lot of people, if you look at it here, got in July 2023 at this breakout. It's been basing for 2 years. Again, very similar characteristic that the other names I talked about. And it's been breaking out over here. And if you track this anchored average VWAP, it has shown to be a clear support level. It didn't break it in February 2024 when it pulled back. It pulled back slightly during the yen carry trade issue. Actually, not the yen. This is the yen carry trade issue. It held up. But during the September sell-off, it broke through but picked back up. And you see over here, it's consolidating. So there's clear support at Coinbase at this level. I do think that it's somewhat worrisome on the volume profile at this level, because if it does break, I think we are in some trouble, because if you look at all their indicators, the metrics, it is below all of them already. So it's a messy chart, but if it holds up the anchored VWAP, I do think it retests this previous high. And if it does, that's a 70% move. And if you guys don't know, I am anticipating a blow off top crypto Santa rally. Like, I think this is November and December is being priced into a blow off top rally for a lot of crypto related assets, especially if Bitcoin can break through that 75,000 level, which it's shown as resistance. But if it does break through, I think it's going to be a blow off top type of move. So I do think Coinbase is one of the biggest beneficiaries off that, because like I said earlier, they make 8x the revenue than Robinhood does on their crypto trading. So that's a massive move. So like once crypto's raging again, I think a lot of volume will start going towards their brokerage. So I went over the first name for Trump-led presidency. It's national security and AI. Second one is crypto industry. What's the third industry that's going to catch a bid on a Trump-led presidency? It's not what you would think. I'm talking EV. A lot of people think that EV would catch a bid on a Kamala-led presidency, and that's absolutely true. There is nothing, you're not wrong in that at all. However, due to the massive advantage that Tesla has over their competitors on a profitability basis, I think if the IRA or the tax credits is removed from EV cars, no other competitor has a profitability margins that Tesla does. Tesla has a first mover, large market share that they can like have the pricing power needed to undercut their competitors, like we've seen in the past 2 years. Their competitors don't have that luxury. So if those tax credits are removed, I think that removes the crush that the Tesla's competitors have been living on for years. And that's just going to allow the best of breed, clear number one, to widen the delta between them and everyone else. So although it might hurt Tesla fundamentals, I think it's more of a pain for their competitors where it's a lesser of two evils, and that's going to benefit their moat or the advantage. And I do think a Trump-led presidency, like the relation that Trump has with Elon, is hard to ignore. Like, they are friends and they're very public about it. I do think that it's going to help. Trump might help a lot with the regulatory approvals needed for robo-taxis or any kind of initiatives on Elon's vision on SpaceX, Starlink, Tesla. Like, regardless, like, I think it's more of a scratch your back, you scratch mine if you become president. And I think that's going to be a major benefit for a name like Tesla. So now you know what to buy. When do I buy it? If you look at the Tesla's chart right now, they just had their 10-10 robo-taxi event just yesterday. It was a big disappointment, as you can see with this massive weekly red candle. There was lack of clarity on exactly when the robotaxi fleet are going to be released. They said the price point is pretty vague, under 30,000. There wasn't any kind of detail that the market wanted. It was very visionary rather than actual specifics on what to do going forward on the robotaxi fleet. So right now the chart looks a little troublesome, where if you go in the past year, this 265 level has been a clear resistance. Like, it is struggled to break through it in October 2023. It struggled again in December 2023. It struggled again in summer of this year. And guess what? Same level, this most recent rally, ever since on the 70% bump from August bottom, it's been in clear resistance then. So I do think that if we do break this 265 level, I think it's going to really break out, where if you, let's see, pull the, this is a great base right here. I think if it breaks the 265, you can see how thin the volume is above it. So like, who knows? Like, I can see us testing the prior highs in 2022 potentially if we finally break over this 265. Worst case scenario, like if it continues going lower, things do get a little worrisome if you can't hold up on this level at the 21 EMA at 219. You can see like it should be holding up there. It's been support prior. If it doesn't hold up there, I mean, maybe the 50 SMA on the weekly charts at 207. But worst case scenario, like this trend we've experienced since 2019. So if we don't break through that 265 level, I do think that a next resistance will be the 207 at the 50 SMA on the weekly charts. And maybe worst case scenario, like you see this bottom trend like ever since 2019, you can see that has been being held up. So like that's a long-term trend resistance. So I'm hoping that worst case scenario, I really don't think it breaks 150, but I just want to give a worst case scenario environment if we do pull back. But I really feels like this is a consolidation level. But if a Trump does win this election, like it will I do think that's going to be a tailwind needed for them to break through the 265 level. And that top is going to be, the prior high is in 400. So like there's a ton of room to run for this name if it breaks above 265, because especially the thin volume. So I've gone over on a Kamala Harris-led presidency, the three themes I think are going to be the hot pockets of. It's going to be solar. It's going to be China names. It's going to be housing. In a Trump-led presidency, it's going to be national security. And I think AI is going to be the main beneficiary of that, which is Palantir, the king of the AI applications. The second is going to be crypto because of the lack of regulations that he kind of has had in the previous presidency. I think that's going to continue. And the third one is going to be EV is going to struggle, but Tesla should benefit because they are the clear winners of this comp, and they're going to benefit from the destruction of their competitors, from that IRA tax being removed. Tesla should be able to catch a major bid from that.
Finally, I'm going to walk you through how I use TrendSpider's seasonality tool to identify the top performing sectors post-election, as well as dig into some key names within each sector. I made a watch list of all the major index, sector, and industry ETFs that I could think of, and I went through them one by one to see if I could find any trends that really stuck out. The first thing that I stumbled on was uranium. Seasonality data on the URA ETF shows us really strong performance in December of election years and the January that follows. In fact, URA offers the highest average return out of all the ETFs I analyzed during these 2 months directly following the election. I think there are a few key names that we should be focused on that could benefit regardless of who wins. The first one is Constellation Energy, kind of an obvious one, but I want to start here simply because of how strong it is. It's currently outperforming 99.2% of the names in the S&P 500. Looking at the weekly chart, it's currently finding resistance at a key level, the 1.618, the golden fib extension from the previous major swing high to low. That's going to be the obvious spot to gain. And then you could use, if you wanted, additional fib extensions to gauge targets higher. If we drop down to the daily, we see what started this leg higher is a huge power gap up on volume on the news that they had signed that deal with Microsoft, a 20-year power purchasing deal where they would be reopening 3 Mile Island to provide that power. Well, when it comes to these power gaps, in the best case scenario, the gap never fills. The price just continues to drift higher. So I think the key thing to watch, at least on these low timeframes, is simply that. The way that I prefer to track it is with an anchored VWAP from the gap up. If price stays above that VWAP, then the average buyer from the gap up is in the money and is supporting the price. If the price drops below the VWAP, then that could become resistance, and perhaps it's best to wait until price is able to reclaim it to establish new long positions. Now, it's also important to note, after that news came out, we saw quite a few analysts revise their average price targets to the tune of about 19% higher. The previous average target was $226 per share, whereas now it's about $270 per share, $269. That's essentially where we're trading at now. So that's something to, kind of keep in the back of your mind. Price immediately went to the average analyst target. The second name I want to highlight is Cameco Resources. Cameco is another one in the group that's looking pretty good. On the monthly, we see it's consistently found support at its 20-period SMA since it gained it back in November of 2020. I'm also keeping a close eye on this monthly bullish MACD cross. You're going to want to see them stick the landing here with that, really continue pushing momentum in the direction of the bulls. Fundamental performance has been solid. Revenue numbers have been increasing pretty steadily over the past few years. Back when price really gained that 20 SMA on the monthly, you see a clear relationship between revenue ticking up and the price moving higher. So I think you want to see that relationship continue. Also, seasonality trends support strength into the year's end, with November and December of election years historically bringing in high win rates and notable average returns, 7.65% and 8.7% respectively. So there's a convergence there between the ETF and the individual name. So now I've got an idea of the sector of the market that I want to be focused on directly after the election. But what about the first year of the new presidential term? The next idea that I had was to see if I could identify any trends in the year that follows an election. And in fact, I found a few. The first one was in home builders, the XHB ETF. And what I found was that in the year following an election year, home builders offer the most instances of monthly outperformance compared to all of the other assets that I analyzed. They have the highest average returns of any sector, specifically in 3 key months, in March, April, and July. And there are a lot of great looking names in the space. You got Home Depot and Lowe's, both looking awesome here, pushing into new all-time highs. Lowe's is leading slightly. You've got home builders like D.R. Horton, Toll Brothers, and Meritage. They're all in these Weinstein Stage 2 extensions higher. Lots of really good looks out here, but I want to look at 2 specific names. The first one is Lennar. Lennar is one of the largest home builders in the U.S., and with their focus on sustainable housing solutions, they're definitely going to benefit from any government subsidies that get distributed for low-income housing projects. So Lennar Corporation has really been on a tear for the past 2 years. It's currently outperforming 81.5% of its sector peers. It's consistently found support within that monthly 821 EMA cloud. Its name has managed to recently gain the 200% Fibonacci extension from the 2022 high to lows. So to me, that is a key risk on or off level. Above 172, we want to be long. Below 172, we want to have a little bit of caution. Also, in late September, Lennar saw a wave of analyst activity, mostly buy or hold ratings, and post-election year seasonality trends point to March as the highest average return month for the name with a 6.83% average gain. So it's kind of confirming what we saw in that ETF seasonality as well. The second name that I want to highlight is slightly outside of the realm of the home builders. It's not actually a home builder name, but it's absolutely necessary to the process of home building, and that's Caterpillar. Now, Caterpillar has shown unbelievable strength this year. It pushed powerfully out of the long-term ascending wedge in February. It retested that breakout spot in August. It's making new all-time highs this month. However, 2 quarters of revenue misses in a row, as well as the expectation of EPS numbers to decrease over the next 2 quarters, could be providing a bit of a warning shot for bulls, at least in the near term. To add to that, relative performance is showing a clear negative divergence, with the stock weakening relative to the S&P 500 with each new high that it's made since 2023. When it comes to relative performance, you really want to see new highs in price correlating with new highs in RP. So this could be a sign that the name is actually weakening a little bit under the hood. We've also seen majority selling from government officials throughout this year's run-up. So these are all things to keep in the back of your mind when considering long positions on the name right now. But all that said, however, if the strength does continue into next year, the highest potential for positive returns in a post-election year on Caterpillar come in the early summer months of April and May. Now, going back to that bigger scale seasonality analysis that I was doing, when I focus specifically on sectors that offer just the highest win rates following or in the year that follows an election, I found that the most consistent performance was in 2 sectors: aerospace and defense and semiconductors. So let's talk about aerospace and defense first. The first one that I want to highlight is a name that I don't personally hear discussed too often, Howmet Aerospace. Now, if you follow us here at TrendSpider, if you follow us closely, you know that we recently released a scanner that identifies CAN-SLIM names. And this name, Howmet, happened to come up in that scan. It's got 10 straight quarters of year-over-year earnings growth. It's outperforming 99% of the S&P 500. This one is a monster, and analysts really seem to like it too. You've got a top target estimate of $125 from Deutsche Bank. On the other side of the coin, you've got a name like Boeing, who's really facing some challenging technicals. It recently broke below its 200-month SMA. It's now testing the ascending trend line from the COVID low. If this area fails, there's a large volume gap below that could act as a magnet for price. So we got to keep a really close eye on it. It's currently underperforming nearly all of the names in the S&P 500, and analysts are absolutely reacting as you would expect them to. All recent price targets have been revised down. However, if you're looking for a potentially bright spot post-election on Boeing here, the highest win rate and average return historically comes in May. The last name that I want to highlight in this sector is Lockheed Martin. For this one, bullish MACD crosses on the monthly seem to be the name of the game. They offer up big gains each time they've occurred over the last 5 years. So it's no wonder that we've been seeing so much buying from government officials over that same period of time. Now, Lockheed's recent period of strength has pushed its relative performance score to over 90, meaning it's outperforming all but about 10% of the names in the S&P 500. And if you're curious how this strength might fare post-election, we find that May offers the best opportunity for gains with a 100% win rate and an impressive 5.5% average return. Beyond the technicals, also, Lockheed continues to reward their shareholders. They recently raised their dividend by 5%. That marks 22 years of consecutive increases. So last but not least, let's talk about the semis. We see the exact same performance from the SOX ETF as we did with XAR. 6 out of 12 months in the year following an election have 100% win rates. Semis are critical for AI development, 5G technology, automobiles, modern defense systems. This sector is going to be a pivotal one. Let's talk through 2 key names. The first one, obviously, NVIDIA. After several months of consolidating and price filling the fair value gap created in May, NVIDIA appears to be starting its next leg higher, if you can believe that. You could see it's attempting to gain the 500% Fibonacci extension from its 2022 high to low Unbelievable performance. Its relative performance score is nearly unmatched. It's outperforming 99.4% of the names in the S&P 500. And despite massive selling of over $700 million in shares from CEO Jensen Huang, analysts are as bullish as ever. Recent buy targets average $154 a share. Seasonally, if you're curious about that, NVIDIA's strongest month in the year following an election is May. It gives us an 86% win rate and an average return of 19.71%. Crazy. Last name I want to talk about here is Intel. It's been a tough road for Intel bulls. Undoubtedly, but the stock is trying to dig in exactly where it has over its many years at the anchored view at from its 1986 IPO. On the monthly, it's also showing a clear bullish RSI divergence in what appears to be a volume climax right at the lows. This is typical of what's seen at major tops and bottoms. In a show of confidence, you've got Intel CEO Patrick Gelsinger. He's also made some purchases this year. You don't see CEOs buying all the time. So when you do, it's worth it to kind of keep it. It's worth it to be mindful of it. So that signals that leadership is seeing potential value at these levels. The last little piece here, seasonality in the year after an election. It might take a little patience for seasonality to play out. The month with the highest potential for positive returns happens to be December. So maybe don't jump right into long positions on Intel, but keep your eyes on it. We'd like to congratulate President Trump on his victory, and we hope that this video equips you with key insights that you can take forward in the months ahead. As always, happy trading, and we'll catch you next time.